Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion we will be talking about the ARMS index. Short for Trin, this is going to be one of the indicators that has been around for some time in the stock trading world, but absolutely can be applied to other areas of trading as well once you understand what it is. We're going to cover exactly what it is, how it's calculated, and how it can be used to help identify potential trading scenarios. But before we go further, please do me a favor and click that like and subscribe button down below so I can keep coming out with videos for you guys. Without further ado, here we go. The ARMS index is also known as the short-term trading index, and it is something that has been around for some time. It's a short-term technical indicator that is used to compare the number of advancing and declining stocks, which is referred to as the AD ratio, to the advancing and declining volume, which is known as the AD volume. It was developed by Richard Arms in 1967. The Trin is used to gauge overall market sentiment. With the Trin, investors can evaluate the relationship between market supply and demand and anticipate future intraday price movements. The Trin generates overbought and oversold levels that will indicate when the stocks are most likely to change direction. The formula for the Trin is written here in green. Now, this is the formula, but remember, the indicator itself is going to be doing the math for you. I just like to cover these things so we understand what is actually being calculated and we're not just trading blind. The Trin formula is equal to advancing stocks divided by the declining stocks, divided by the advancing volume, divided by the declining volume. So it's a very simple formula. The advancing stocks is equal to the number of stocks higher for the day. The declining stocks is equal to the number of stocks lower for the day. The advancing volume is equal to the total volume of advancing stocks, and the declining volume is equal to the total volume of declining stocks. Although most charts do already include the Trin indicator, the Trin indicator can be calculated in a few easy steps. The first step would be to just choose our intervals. That means we set our intervals to whatever we want. It could be, say, 5 minutes, every hour, daily, whatever it is we're interested in measuring. Then step 2 would be to divide the number of advancing stocks by the number of declining stocks to calculate the AD ratio. Step 3 would be to divide the total advancing volume by the total declining volume to get the AD volume. Then for step 4, we'll divide the AD ratio by the AD volume. After this, step 5 is to simply record the result and plot it on the graph. Then we'll repeat the same steps over and over with each passing interval. When we connect the data points on the graph, we'll see how the Trin trends over time. Let's talk about what the ARMS index tells us. Well, by analyzing both the strength and the breadth of the stock movements, the ARM index gives us a real-time explanation of the overall movements in the market indexes themselves. A value of 1.0, for example, indicates that the market is in a neutral state. Why, might you ask? Well, that's because a value of 1.0 means that the AD ratio is equal to the AD volume, and that up volume is evenly distributed over advancing stocks, while down volume is evenly distributed over the declining stocks. The Trin indicator provides a bullish signal when it is less than 1.0 and a bearish signal when it is greater than 1.0. When the level is less than 1.0, that means there is a greater volume in the average up stock than the average down stock. When the level is greater than 1.0, that means there is a greater volume in the average down stock than the average up stock. The further from 1.0 that the Trin indicator's value is, the greater the contrast between buying and selling on that day or interval. A strong up day, for example, will push the Trin down, while a strong down day will push the Trin upwards. The Trin is a breadth oscillator that helps measure the internal market strength or weakness. It is a short-term technical trading tool that measures volatility in the stock market and, as such, represents the relationship between advancing and declining stocks over volume, like we said. If the Trin is trending upwards, that means the market is weaker, whereas if the Trin is trending downwards, that means the market is stronger. The Trin often moves inversely to the index when it's being analyzed. When the Trin spikes higher, sell-offs usually occur. When the trend drops sharply, rallies usually occur. Often, traders will include a moving average on the index when evaluating the trend. By analyzing the moving average, the data can be smoothed out while giving investors a better understanding of whether or not the trend is going up or down. The moving average also aids in identifying support and resistance areas as well. Finding overbought and oversold levels in major indexes is one of the main goals of the Trin. We already mentioned that 1.0 is the neutral value and that the Trin moves inversely to an analyzed index. Very high or low readings in the Trin indicator may signal that the levels are either overbought or oversold and due for a reversal. While overbought and oversold levels may vary slightly by the index being analyzed, the Trin can always tip us off. When the value of the Trin indicator dips below 0.5, that may indicate overheating and an overbought market. When the value of the Trin indicator exceeds 3.0, that may indicate an oversold market with an extreme over-bearish sentiment. While the trend indicator isn't always correct, it is very valuable and it helps tip off these moves to us as investors prior to a dramatic price shift or potential reversal. When trading with the trend indicator, it is especially helpful when day trading or swing trading. Traders look at the value of the indicator and how it changes throughout the day. They also like to look for extremes in the index value and are always looking for signs that the market may soon reverse whatever it is currently doing. When using the trend indicator, the best thing to do is to combine it with other indicators or outside price knowledge to further confirm the read. It is always important to combine the use of outside knowledge with the trend indicator as it is with just about any other indicator out there. Some good combinations would be Bollinger Bands, for example, to help us avoid some miscalculations and potentially false signals. When we look at this chart here, this shows the S&P 500 in an upward trend for 1 year. We can note that the S&P was trending upwards, and while it was, the trend indicator was below 1.0 on the bottom side of the screen. Further confirmed by the double exponential moving averages that are on the chart, helping us gain a strong read of the trend that is in play. This chart of the Nasdaq shows another example of how the trend indicator compares with key turning points in the Nasdaq chart. By using the trend and focusing on the Nasdaq's price movements, we can make several observations. If we utilize the trend and we're trading the Nasdaq at this time, we could make several strategic moves as well. In this example that we have here, when the trend is above 1.0 yet below 2.0, it signals that the stocks are under pressure and a short-term decline might be near. In this example, there are 3 instances that we already have circled where the trend spiked and signaled a short-term correction in prices. On this chart, the candlesticks marked by the red arrows show the resulting price action after the trend spiked. In the first instance, on the left, there was a morning star type of candlestick pattern. In the second instance, there was a Harami-like candlestick pattern showing support from the 50 and 200 period moving averages. In the third instance, the trend spiked and indicated a decline. There was a subsequent bullish reversal with a candlestick pattern helping confirm. While these patterns each have differences, there is generally a 3-step trend here. The step 1 is the trend signals a correction by spiking and price falls accordingly. Step 2 is price confirms a reversal and is further validated by its volume. Step 3 is price exceeds the previous high. Another great way to trade with the trend indicator is to apply the Bollinger Bands like we were mentioning. By using the trend alongside the Bollinger Bands, traders can strategically decide what moves to make depending on when the trend spikes and test the upper level or lower level of the bands. Bollinger Bands are very popular because they consist of 3 bands on the chart and are relatively easy to read and relatively reliable as well. The middle line is usually the 20-day moving average and serves as the base for the upper and lower bands. The upper and lower bands are usually set to 2 standard deviations away from the moving average and are used as a way to measure volatility by observing the correlation between the bands and price itself. Using the Trin indicator with the Bollinger Bands can look something like this with this chart here, where we have a few cases of the Trin spiking on bottom circled already, and what price did also added to reaching the outside area of the band and then shortly dropping thereafter. This occurred a couple times over, as you can see. There are several advantages of using the Trin indicator, so let's cover a few of those. As we discussed, when dissecting the calculation of the Trin, a tool like the Trin gives traders a deeper insight into market performance and trends by examining which assets are advancing and which ones are declining. Also, another advantage, the Trin compares advances to volume. While most traders only pay attention to price movement, volume truly plays just as big of a role. Price movements that correlate with high volume hold more significance than price movements that correlate with low volume. Why? Well, low volume usually does not cause a significant price shift, while high volume implies a larger scale significant shift that may last longer. Also, the Trin provides traders with a clearer picture of what is truly going on in an index, and that's a simplistic benefit, but it is a benefit nonetheless. Also, the Trin is a good indicator to predict stock movements because of the way it calculates in a rather simplistic manner. With the Trin's formula, its values serve as buy, sell, and even hold signals. These values tip off traders on which way a stock index might be trending. While the Trin indicator has several advantages, there are also some limitations that we should talk about as well. The first is the Trin is always prone to inaccurate results at times because of the emphasis it places on volume. For example, if there's an instance when there are twice as many advancing stocks as declining stocks and twice as much advancing volume as declining volume, the Trin would yield only 1.0, which would equal a neutral indicator reading. Additionally, say that there were 3 times as many advancing stocks as declining stocks, and twice as much advancing volume as declining volume. Despite the bullish day, the Trin would yield a 1.5, which could equal a sell signal. These instances are clear examples of how the Trin can be misleading if we follow it blindly without taking outside information into consideration. If we were to elaborate further on that, the Trin is not always going to be reliable as a standalone indicator like we've mentioned. Once we couple it with Bollinger Bands, the Trin then becomes a much more powerful adversary and much more appealing to traders of all types. So, in conclusion, while no single trader, or no single indicator I should say, is ever going to be able to accurately predict the future, at least on the broad scale that we'll all be able to access, the Trin indicator does a very good job of providing valuable information to us. But as with all indicators, it's important for us to use outside knowledge, outside price action to further confirm the reads that the indicator is providing. Just because the indicator doesn't work 100% of the time doesn't mean that there's no value in it. Remember, we can be profitable traders even when we only win 60 or 70% of the time. Other than that, folks, thank you for joining me again. It's always a pleasure. I'll see you in the next one. Cheers, folks. Happy hunting, happy trading, over and out. Bzz.